Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based insights to help you master the game of building wealth. And in today's episode, I'd like to talk about property development and is it still profitable, having a look at some real life examples where I've been able to go back and complete a financial analysis based on, what some clients have done in the past. So it's kind of good to sort of revisit the strategy. You see, there's really three ways generally to build wealth and make money. One of them is passive investing. Second one is, go and start a business or make money through business. And the third is speculation. And if you think about this as kind of a Venn diagram, if you like, those three circles, passive investing, business, and speculation, the reality is that sometimes different strategies overlap and it can be a combination of both or maybe all three sometimes of those categories. Now, this podcast is very much focused on passive investing. It's not really talking about business. I'm certainly not going to talk about speculation. To my mind, passive investing is really about earning the highest return for the lowest risk. So a return high enough to ensure that you're able to meet your goals. And then it's just about reducing risk and taking risk off the table. And putting that differently, it means taking risk off the table just means you have a much, much higher probability, or the highest probability, if you like, of actually achieving your goals, which is what people want. So for instance, if you can earn 7.2% as an average return, compounding, every 10 years your wealth will double, your assets will double in value. So starting $1 million today will be 2 million in 10 years, 4 million in 20 years, and 8 million in 30 years. That's pretty much enough for most people to achieve their goals. So therefore the question then becomes with passive investing is how do I earn 7.2% and take the lowest risk? Pursue a strategy with the highest probability of achieving that return. Anyway, let me digress because I'm talking about investing, business, and then sort of speculation, if you like. And as I was saying, sometimes they morph into each other. So, a small scale property development, for example, is kind of like there's a little bit of passive investing in there, but it's mostly sort of business because what you're trying to do is create a product essentially, and you want to manufacture that product for a cost less than what its end value will be. Plus, also, it takes time. So, some of your input, or you've got to pay a professional to replace that time. And then there's additional risks over and above what you would normally confront just with a sort of passive property investment, if you like. Now, investment fundamentals rarely change. It's not impossible for them to change, but they rarely change, particularly and this particularly relates to pure passive investing. So for instance, a buy and hold strategy which is really investing in investment grade property, is really premised on the belief that well-located scarce land in an area where supply is fixed, the value of that land will appreciate over time. And that's the premise, that's the whole rationale behind that strategy. And that principle has certainly held true for many decades, and I think it's going to hold true for the coming decades. Now, it can't hold true in perpetuity because at some point that land becomes unaffordable to everyone, but I don't think we need to worry about it in our lifetime and probably not even in our kids' lifetime. However, when strategies mix elements of business or speculation with pure investing, it gives rise to additional risk, and that's what we really need to think about. And that's why I wanted to kind of revisit the property development strategy based on these numbers, given, some things have changed over the last number of years. So towards the end of last year, I had the opportunity to work with a new client that engaged my firm to build a long-term strategy for him. And it was a really interesting situation or scenario, if you like. And thankfully, we were able to, I think, design a very cohesive and coherent and effective long-term strategy for the client. Now, this client back in 2006, with the help of a buyer's agent that really specializes in small-scale property development, purchased a house in a really good suburb in Melbourne with a block of land of 630 square meters, and the purchase cost him $540,000. So it had an old house on there, large enough piece of land that they could develop. And over the next few years, the client demolished that house and built 3 townhouses at a total cost of $645,000. Now, of course, that $645,000 for 3 townhouses looks cheap today. Of course, we've got to think about the time value of money, because adjusting for inflation, that amounts over $1 million today. But still, in relative terms, that's still cheap. So fast forward to today, those 3 properties are now worth around $3.2 million in total, and they're generating just over $2,000 a week in rental income. Now, thankfully, this client maintained fantastic records, and that allowed me to go back and analyze the financial performance of this investment over 2 decades. And I was able to calculate the exact after-tax holding costs of the property, including depreciation, over that period of time. And I like this example because since 2006, we've had periods of very high interest rates, periods of low interest rates. We've had many property cycles over that time. So it really is a good live case study on how a property investment can work out, and how changes in interest rates, for example, can impact cash flow, changes in tax legislation and tax benefits and tax deductibility. So quite often, we do projections, of course, financial projections, and we've got to make some assumptions. Now, we're really confident with our assumptions that we make because we've been doing it for more than 2 decades. But it's good to go back and have a look at, how investment has performed over that long period of time. And it is a relatively long period of time, of course. So based on this analysis, I estimate the investment's after-tax internal rate of return. And remember, internal rate of return is a measure of what return this client has generated from the investment that they have made over the last, since 2006. So since 2006, they would have borrowed to buy that full cost. They did borrow to fund the development and construction. But of course, they've had holding costs over that period of time, and those holding costs have changed and interest rates have changed. So that's their contribution. So they've put a lot of money into this property. What have they earned in terms of return? If they went and sold the property, repaid the loan, paid capital gains tax, selling costs, all those sorts of things. So the internal rate of return of this investment, I've calculated after tax, 14.8%. So 14.8% this client has earned really since 2006 on an after-tax basis. Now, of course, that's an excellent internal rate of return. Anyone's going to take that. And interestingly enough, before he did the development, this client, the firm that helped him produce some projections of what they expected the internal rate of return to be, almost bang on 14.8%. I can't remember off the top of my head what it is now when I'm recording this podcast, but almost bang on. So well done to that firm, that they produced that analysis back in 2006, and they've certainly delivered, or that investment has certainly delivered on those expectations. Now, what's driving this relatively high internal rate of return? Well, mainly because the properties were newly constructed, they're producing strong rental income, or at least they were producing strong rental income when they were first, put to market, because they were brand new properties, look lovely, good floor plan, all those sorts of things. And so that means the holding costs associated, particularly if you got some depreciation deductions, the holding costs were relatively low relative to the amount invested. And then the capital growth, because they bought in a suburb that was really attractive and still attractive, the capital growth rate over the last 20 years is around 5.8% compounding. So that's not shooting the lights out, but that's probably what you should expect from an asset like that, because don't forget, we're changing the nature of the asset when we develop it. So they would have bought a very land-heavy asset, big block of land, 630 square meters with a very old house on it. That's mostly land probably. And when they're finished, they've got 3 townhouses. So the improvements are worth more than the land. And so that's going to have an impact, just mathematically, it's going to have an impact on the capital growth rate. So that's why we've got 5.8%. It's not terrible, but it's not shooting the lights out. But relative to the holding costs, that's a good return. And that's why the internal rate of return is so high. And so just to put some numbers around this, in today's dollars, over the last 20 odd years, the client has spent $270,000. That's what they've contributed into the investment in terms of after-tax holding costs. If they sold the property today, paid all loans, tax, CGT, all those sorts of things, they'd walk away with about $1.4 million in their pocket. So essentially, to put some context around the internal rate of return of 14.8%, essentially what they've done is turn their $270,000 of cash flow over the last 20 years into a pile of cash worth $1.4 million. And that's for them to be able to do that. The implied return on that cash contribution is 14.8%. So that kind of makes a lot of sense. Now, that's a great outcome for this client, but it's really important to understand that a few things have changed over the last 20 years. As it does in business, there's no industry that stands still or stagnant for 20 years. And so if we are pursuing a strategy that has a business element, like small scale property developing, we need to consider, what has changed in the industry and whether we can achieve the same results as this client did when he started back in 2006. So firstly, cost of land. We need to talk about that. It's increased substantially, as you would expect. The client purchased a block of land, 360 square metres in a bayside suburb in Melbourne, about 15 k's away from the CBD. So in that sort of inner ring, blue chip sort of suburb. Now, if you adjust for inflation, essentially what that client did is paid about $1,400 per square metre for that land in today's dollars. Now, if you want to be able to buy land for $1,400 per square metre, you have to look much further out in, probably Melbourne's sort of newer outer suburbs, perhaps 30 or more kilometres away from the CBD. So you're not going to buy a land in the same area in terms of quality, investment quality. And when I'm talking about investment quality, I'm talking really about how much is that land in demand and how fixed is supply. So in that inner city bayside suburb in Melbourne where this client owns this property, there is virtually no vacant land available. And you would have to go another 15 kilometres or 10 or 15 kilometres to find vacant land. So it's very scarce supply, in fact, fixed supply and excessive demand. And that's what's really driving the value. So therefore, to try and achieve the same returns, which is really low holding costs and 5.8, 6% capital growth, you have to really spend more on land. To find a parcel of land, 600 square metres in a blue chip suburb like that, 15 k's from the CBD, you're going to have to pay probably more than double $1,400 a square metre. It's going to cost you a lot of money. And of course, that's going to adversely affect the viability of that development. It's just not worth developing land in those really established suburbs anymore. It was 20 years ago, it was viable, not as viable today. So therefore, it means then you've got to make a viable development, you've got to go further out into locations that might be less desirable or less investment worthy. And there's going to be trade-offs associated with that. So will you achieve that 6% capital growth rate? It's probably unrealistic, which is going to weigh on the internal rate of return. The second observation is construction costs, which you'd already be sort of thinking about, particularly when I started this episode. It's been well documented that construction costs have increased substantially. And when you look at the ABS's House Construction Industry Index and compared what the index is doing, since 2006, it's up 15% over that time. But, I think we all know that in real terms, so I don't know what this index is really telling us, because in real terms, we know that cost of building has increased substantially, even just as a result of COVID. And many residential developers believe that costs have risen 20 to 30%, or even in some circumstances more than that. And I was talking about this to someone recently, and it's really around labour costs. The material costs have come down, not to pre-COVID levels, but they're not as elevated anymore. It's really labour, and that labour is being eaten up by government-funded construction projects. And that's been well documented. So certainly it costs a lot more to build that property in real terms and relative terms today than what it did back in 2006. So then if I went back, and if I go back into the model, instead of the client spending $645,000 to build those 3 townhouses, let's add 30% and say back in 2006, 2007, the client spent $840,000. Well, that reduces the internal rate of return from almost 15% to 11.7%, which is still attractive. It's not bad, but of course, that's going to have an impact on the viability of small scale developing as an investment strategy. And then if you adjust for the cost of land or a lower capital growth rate, the internal rate of return decreases even further, of course, to the point where a traditional buy and hold strategy would deliver the same return with less risk. Now, this is only one data point. So I'm looking at one scenario here. Now, I like the scenario to look at because, firstly, we've got a lot of data. We've got a lot of reliable data. So we've got a lot of data in terms of longitudinal data. So, it's over many years, almost 20 years. And the client maintained fantastic records. So I know it is exact as well and accurate. I also liked it because it was a development. If that development's not going to deliver the returns, then I question which one would, because it was done in such a good suburb. And on the face of it, the performance looked really good. I thought it was a really good case study to work with, but I acknowledge it's only one data point and there are exceptions to every rule. But actually, I looked at the next development because the client did that one it bought the land back in 2006. A couple of years later, the client did another one in 2008, another sort of small scale development. In this situation, the property he bought, he had to pay more, $1.1 million, which I think goes to the point that it's costing more to sort of buy these sites, if you like. And demolished the existing dwelling and built 2 4-bedroom townhouses. So 2 much sort of larger townhouses, if you like. And the construction cost was just under 1.2. So again, 2 years later, development costs are a lot higher. Now, today, these properties are worth around $4.2 million in total, the 2 properties, and generate combined rental income of about $110,000 a year. It's a pretty strong sort of income profile, if you like. So this development hasn't performed as well as the first one. Main reasons for this: higher acquisition costs, higher construction costs, and then higher negative cash flow. So there's more capital contribution just because of higher borrowings as a result of the higher initial costs. And also lower capital growth. It's about 3.9% per annum, as opposed to nearly 6% with the first development. And the internal rate of return for this one is around 11% on an after-tax basis. Again, you're still not going to be angry with someone that recommends an investment that generates an 11% after-tax return, but certainly not as good as the first one. And it's getting close to really being not really worth the risk of taking or undertaking a development. Now, we can't get too fixated on internal rate of return, or if we do, we need to consider a bunch of other factors in addition to internal rate of return. And that's because we just can't look at it in isolation, because everyone has a certain amount of cash flow they can invest and everyone has a limited amount of borrowing capacity. And your borrowing capacity is a scarce resource, not the investment opportunities. Therefore, you've got to then think about, how can I allocate my borrowing capacity into an investment that has an attractive internal rate of return and also soaks up all my investable cash flow. So let's say your borrowing capacity limit is, say, $2 million. And really what you're doing is comparing 2 investments using that borrowing capacity. A small scale property development, building something 2 to 3 dwellings, just like the examples I've just provided you, or a buy and hold investment. Now let's assume the internal rates of return for those 2 investment options are the same. And I think they broadly will. I think the analysis that I've done to date will show that they're going to be relatively the same. Look, maybe there'll be some differences, but they're not that material. So then we've got to think about, okay, the small scale development will have lower holding costs, which means that I need to invest less of my cash flow. And assuming it's got the same internal rate of return as the buy and hold strategy, it means that I will build less wealth because I've earned the same return, but contributed less of my capital. Conversely, the buy and hold investment, on the other hand, requires obviously a larger investment from me ongoing to cover the holding costs. Just because I'm buying something that's going to be land rich and therefore not generate as much income, and so the holding costs are going to be higher. So I'm going to have to put more of my capital in. But as long as the internal rate of return is the same, then I'm going to, at the end of the day, build a much bigger pool of assets. So that's why we need to think about borrowing capacity, the amount of wealth actually accumulated over time, and then the internal rate of return. We need to consider all those three things. Because if I look at it and go, okay, I'm going to do the small scale development, I know it's going to require less cash flow. So actually, I can afford to do 2 or 3 small scale developments. But the problem with that strategy is I might not have the borrowing capacity to do that. So I pursue a small scale development on the basis that it's going to be more affordable in terms of ongoing holding costs. And that might be fine. That might be perfect. But it just depends on what your borrowing capacity limit is. And also depends on how much surplus cash flow you have. Because you really want to find an investment option that does a number of things. Soaks up all your investable cash flow and delivers the highest internal rate of return. That is actually going to be the most effective strategy because it will actually deliver, at the end of the day, more money in your pocket. In terms of, when you go and sell that investment, how effective will it be in terms of building your wealth? That's the most important thing, right? Because that's how you're going to fund retirement. So a 14.8% internal rate of return is excellent. In fact, I'd love to put all my cash flow in it, but I can't put all my cash flow in it because the property dictates how much I can invest in that asset. And I can't invest in, 10 of those assets because of borrowing capacity limitations. Look, let me put it a different way. Investing $70,000 a year in an investment that delivers, say, a 10% internal rate of return actually generates more wealth than the alternative of investing, say, $30,000, a lot less, in investment that delivers a 15% internal rate of return. And that's because the amount invested plays a major role in how much wealth you accumulate. So really the purpose of developing a financial plan is really to answer one key question. How do you convert your cash flow throughout your working life into the largest possible pool of wealth by retirement? And looking at an investment's internal rate of return alone won't help you find the answer to that question. You need to zoom out and take a sort of broader look on both borrowing capacity and how much surplus investable cash flow you have. So then what does that all mean? Small scale property development could be a good option, particularly if you can get in a 15% internal rate of return. Look, you're probably not going to get that high anymore. It's probably going to be somewhere between 10 to 15%, but that's good. That'll help, and that'll probably help you achieve your goals. And a small scale property development could be good for those people that really can't afford the holding costs, the high holding costs of a traditional buy and hold investment grade property, something that's going to be high growth, low yield. If you can afford that, that is a better option. But if you're in the situation where you can't afford a property like that, well, maybe a small scale development might be a good solution in that situation. But there's a couple of key challenges which I've highlighted. Of course, construction costs have risen a lot, and I've seen, unfortunately, a lot of people get a lot of sort of, let's call them dodgy buyers agents, try and sell development opportunities to people that don't have a lot of experience, and they're selling property that really just can't be economically developed. So be really careful about that. I think if you're going to go into a development, I think getting some advice and even then getting some independent advice to make sure what is being suggested to you is going to deliver the returns that you hope and expect. I think that makes sense. And then secondly, the other challenge is going to be where can you buy the land? And then therefore, what capital growth can you expect from that land? If you're buying in the middle of nowhere that really isn't serviced much by public transport and, our roads just get more and more clogged. That's not going to change anytime soon. And so if it doesn't have as much amenity, of course, then you're going to suffer from a capital growth rate perspective as well. Now, I think you can achieve a internal rate of return of 10 to 11% after tax from a investment grade buy and hold property. Now, if I'm going to undertake a development, you want to be compensated for the risk of, the additional risk of going through the development, higher costs, it might not end up how you hope, all those sorts of things. So you want an internal rate of return materially more than 10, 11%. How much more really depends on your risk profile and your situation. But I think you'd want to add a couple of percent to that at least. So that'd be the first thing. That'd be the other thing to consider as well. Are you being rewarded for that risk? Now, before I finish off, because I thought it was a really good sort of case study to share with you, there was a couple other interesting observations that aren't really that related to the development per se or the topic of today's episode, but still I thought they were worth noting. Firstly, holding costs. So when the client completed development, holding costs were around about 22% of gross rental, but they've accumulated now to about 30% of gross rental. Now, I recorded an episode about this in June last year, episode 309, talking about holding costs. And I reached that conclusion that they're about 30% now and that they've risen over a period of time. This example or analysis just confirmed that conclusion. So I thought that was worth mentioning. The other notable point is the client didn't maximize negative gearing benefits fully throughout the whole holding periods. In fact, there were several years where the client's taxable income was either very low or completely wiped out as a result of the property's holding costs and the negative gearing. So negative gearing losses become less valuable if your taxable income is less than 135,000 because it means that you're no longer in that 39% tax bracket. So really looking at this client has geared too heavily. And as a result of gearing too heavily, they haven't been able to enjoy the tax benefits that they should have. And this is just, I think, a bit of a cautionary tale for some people that, borrowing to invest is great, but you can overdo it and that'll impact the effectiveness of the strategy. So you really want to keep your taxable income, say, north of 45,000 at least, because at least then, you're getting a reasonable tax benefit. But if you're going to risk gearing to a level where you've got zero taxable income, that's something to avoid. Okay, let's jump into some listener questions. First one is from Jess. Jess writes, my partner and I own an apartment in Middle Park in Victoria, looking to sell it for around $980,000, would leave us with a $350,000 deposit. We want to buy a house in Elwood but can't afford it. My partner's mum owns, without a mortgage, a townhouse in Elwood worth $1.6 million, has no super. She wants to downsize to a 3-bedroom in Elwood for around about $1 million and keep $600,000 for her retirement. They have decided they want to buy a double-fronted property in Elwood. It's 6 bedrooms, effectively 2 houses on one title. It's $1.8 to $2 million, split it down the middle and then retitle into 2 different properties. So we can get a decent sized 3-bedroom for, say, $950,000 to $1 million. Do you recommend this financially? Lifestyle-wise is another question, but a mum is quiet and keeps to herself. Just wondering, thoughts financially? Seems a win-win from both of us. Okay, I've had 1 or 2 clients do this in terms of pooling financial resources with elderly parents, ones that might need, some assistance with their retirement and sort of cohabitating together or on 2 different titles, so a similar sort of situation. If you can retitle the asset so that if you can control your portion separately to your mother-in-law's, Jess, it's probably okay. The only other consideration then I would think is, am I buying something in the area that is going to be in high demand? So sometimes you can buy an asset, you want uniqueness in a property asset, so scarcity, but you don't want the property to be so unique that it doesn't have wide appeal. So that's the key thing here. Will you be able to sell that individual property, so your 3-bedroom individual property, to someone? Will it appeal to the broad market? So does it provide plenty of privacy? Is it a good floor plan? Is it in good location? All those sorts of things. Sometimes when you find these properties that have kind of been joined together, the floor plan can be a little bit funny, doesn't work perfectly well. Sometimes to split them up and create that privacy, even noise privacy as well, can be challenging. And look, if you've got a shared wall, that's kind of okay. That's, in an attached home, that's what you would expect. So buyers would tend to expect that. But I would just do a bit of due diligence, maybe, and speak to some agents, buyers agents, and just say, look, if we do this to the property, do you think it will be marketable? Do you think we have any issues here? because it's a considerable investment, it's a considerable decision, and you want to make sure that if you're going to put $1 million into this asset, Elwood's a lovely place. You want to hope that it's going to grow, so it's a good lifestyle and financial decision. And also, you don't necessarily want to be tied. Whilst you might be able to pull your money and buy that particular asset together, you don't necessarily want to be tied to your parents in any way, so that you can make your own financial decisions independently of them. But I think if you can tick those main two boxes, from what you've told me, I don't have any concerns or experiences to share with you beyond that. Okay, we've got time for one more. This is from Mr. Z. Okay, Mr. Z writes, 23, working full-time in the resources sector. I recently purchased a unit in Glen Ira within a block of 4 for 660,000, 2-bed, 1-bath, and large contained garage workshop area, 88 square metre floor space with small outdoor area and some shared common property, probably driveway or something like that. The building could use a bit of an update, last renovated in early 2010s, but does not require anything major other than the usual maintenance type stuff for older buildings. It was built in the 1980s. I'm keen to get a larger house within a blue chip suburb as soon as possible, but it'll be a few years before my borrowing capacity increases. Do you think renovating such a property would add value in the next 3 to 5 years versus relying on capital appreciation? For reference, neighbouring houses are valued at around $2.5 to $3 million. And do you think the value disconnect between units and apartments in the southeastern blue chip suburbs is likely to close or widen over the next 5 years? Thanks. Well, Mr. Z, obviously being from Melbourne or in Melbourne, I certainly know the type of property that you've bought, and I would say that it's suffering just as much, if not more, than investment grade apartments in terms of the value of houses, say in Glen Ira, versus the value of those sort of old 80s styles units, 4 on a block, driveway down the centre, for example, that sort of style of property. I think they're intrinsically undervalued to the same extent. In fact, I think they're better assets because there's, obviously fewer people. There's only 3 other owners in your block. So you have a greater chance of banding together with 3 owners and selling it to a developer, for instance, than if you were in a block of apartments with 9 other owners, if there's 10 on the block or something like that. You've got to keep the property in keeping with the area. So people that want to live in Glen Ira, that's probably going to be either first home buyer or a downsizer. Neither of those really want to do any work. You are going to attract a premium if it's really just walk in and it looks perfect. And if all you're doing is cosmetic things, then it will definitely add value, irrespective of what the market does. So if you're keen to sort of leapfrog into a house in the southeastern suburbs in a good blue chip suburb, you really do need to hope that the market generates growth. I'll come to that. But also then try and manufacture your own growth. So absolutely, I would, if I was in your shoes, I would definitely try and bring the property up to spec. Of course, you want to do that as cost effectively as possible. And while you're living in the property, you probably can do that. And hopefully you're a little bit hands-on too. That can help as well. And, to make sure you sort of bring the kitchen, bathroom up to spec, flooring, window furnishings, maybe a paint, those sorts of things. If you can spend some money on those sort of things, you're definitely going to get your money back. And I think it's definitely going to improve the value. Now, let's talk about the relative value between houses and units and then houses and apartments. That gap is wide, the widest it's ever been, really, if you look back since the start of the 1980s. So we know mean reversion will kick in. We know fundamentally, if you got together with those other 4 owners and sold the whole parcel, maybe not in today's market, but in a normal market, maybe in a year's time, for example, you're going to realize more than $660,000 as a result of selling that parcel of land. So we know the fundamental value is certainly different. And yes, I do. I think over the next 3 to 5 years, you will see some good growth. I think by bringing the property up to spec, you will set yourself apart, particularly if there's others in the block that haven't done that, or if there's other units in your area that haven't done that. It'll set you apart and hopefully attract a higher price. So I think it's a good strategy. I think you've bought into a market that is very intrinsically undervalued. Like, I think if we pick different sectors of the market, which ones are more undervalued than others, I think a unit in Glen Ira is a perfect example. And it will appeal to that downsizer market, typically because it's on one level. got a bit of an outdoor area. So it's like a small house, really, but without all the maintenance issues. So well done, Mr. Z. Good choice there. And I wish you all the best. And thanks for writing in. All right, out of time now. Have to leave it there. But until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.